I'm going to draw the payoff charts for a call holder and a call writer. And a payoff chart is basically just a graphical representation of how much money you're going to make on the transaction. So if I set up a chart like this, and the horizontal axis is going to be the stock price of the underlying security, we're going to stick with the same example that we did on the call option for Alphabet at 1450 exercise price and a premium of 65. The vertical axis I'll put as the profit or the loss. So one of the key points is always going to be the exercise price. So 1450 is the exercise price, and at this point the option, at this point or lower, the option doesn't get exercised. If you're the holder, you're not going to buy the shares by exercising at 1450 when you can buy them in the marketplace for a price cheaper than that, 1200, 1300. So you would just let the option expire, and the consequence of that is you lose $65. So at that point you lose your premium of $65, and any price below that you lose your premium as well. Now as we get above 1450, you're going to make some money by exercising the option because you're buying it at a lower price than it's trading at the market. However, you need to make another $65 just to cover your premium and to break even on this whole transaction. So if I add the two together, the exercise price and the premium, I'm going to get 15, and at that point essentially you break even as a call holder. You made $65 by exercising, covered your cost, so net zero on the transaction. And if I connect those two, I'll get the chart. It's an upward sloping curve. The further right you go, the higher the stock price goes, the more you'll make. So this is the payoff chart for a call holder. And what is the payoff chart for a call writer? It's going to be exactly the opposite. Because a call writer, it's a zero-sum game. So what one makes, the other loses. So at a price where it's not exercised, which is 0 to 1450, the writer gets to keep the premium. So they make a profit of $65. And then as the price goes up, they start losing money because they have to provide the stock at a cheaper price than market. And their break-even is exactly the same as a break-even for the holder. So at 15.15, the premium is offset by the loss on exercising for the writer, and then you connect those two and you get the payoff chart for the call writer. And again, it's a zero-sum game, so that's why one is the mirror image of the other.